Welcome, everybody, to Eurodollar University's Questions and Answers, a member exclusive. Let's get right into the questions. We got a couple of them coming in about potentially a cash crunch in the banking system. The Federal Reserve is winding down its bank term funding program. Remember that emergency crisis that emerged back in March of 2023. And they shut down the loans, new loans to it last year, or earlier this year, after some hedge funds and other, not hedge funds, but banks were taking advantage of the arbitrage opportunity that was offered by it. And so they're shutting down the bank term funding program, trying to get the banking system and participants in the banking system to use the discount window. But banks don't want to use the discount window. In fact, they continue to avoid it. So that sets up what people are asking about as potentially a collision course as the bank term funding program is winding down and they don't want to use the discount window. Is there potentially a cash crunch coming, maybe leading to more systemic problems like we saw in early 2023? Joining me for this question and answer session is Eric Besmajian from EPB Macro Research and Mr. Mike Green from Simplify. Mike, let's start with you. What do you think about potentially a cash crunch coming in the bank system as the bank term funding program winds down? Plus, we also got to pay attention to QT and the level of bank reserves too.
Yeah, I mean, the quick answer that I would offer is that we can't possibly know if a cash crunch is coming because it is a stochastic event, right? We can't know what the true exposures are. We can assign some probability to it. The BTFP solved a liquidity crisis on a short-term basis, but I think much more important was the universal guarantee of deposits that basically stemmed the massive outflows. And from that point, we've actually seen deposits in the banking system rise back towards their peak in the absence of another cycle of deposit outflows tied to something like much higher interest rates that can be earned in money market accounts versus bank deposits. I struggle to see that this is going to manifest itself in anything immediately. On the flip side of that observation, though, I would just highlight that we continue to see sources of stress across smaller banks in particular. We actually just had our first bank failure a couple of days ago, since the events of March 2023. And now it becomes a question of, are we actually going to start to see a recovery in the areas of the economy that have been really hard hit in the banking sector? Commercial real estate would be one of them. My general view is that the backup in rates that we're seeing is putting the kibosh on a lot of the enthusiasm for, a renewal of the housing market, a renewal of the commercial real estate market. It seems more likely that we experience economic weakness rather than a surprising shock and dollar shortage.
Yeah, I think about this as far as like you are, that this is, we're not looking at another 2008 style replay where we have large banks failing or threatening to be nationalized. I think that's I agree with you that the area that needs to be addressed and the area that the Fed doesn't seem to want to address, at least not directly, is the smaller regional regional institutions. Again, their solution is go to the discount window, whether you have collateral or not. Eric, let's get your thoughts on the same thing.
I echo a lot of what Mike said. I struggle to see how there will be a system-wide cash crunch or liquidity crunch, particularly when you rope in the bigger institutions. As far as the banking system, what I'm watching, I'm not as well versed in the interworkings and the plumbing as you are, Jeff. I'm looking at it more from a holistic macro sense that there's something that's curtailing the bank's willingness to lend or consumers or businesses' willingness to borrow. Because if you look at total loans and leases across the entire banking system, it's only growing at about 2%, which is less than the rate of inflation. So we're in a situation where we have negative real bank lending growth. Generally speaking, that coincides with periods of economic downturns. It's been a little unusual this cycle since we've had a scenario of negative real bank lending pretty much since the SVB crisis in March of 2023. So as far as the banking system, there's something that's preventing the gears from turning and extending real credit growth to the economy. And in my opinion, it's that banks, particularly the smaller regional banks, which do the lion's share of lending in the economy, have a situation where assets are underwater on their balance sheet. And I'm not really referring to the held to maturity security assets. Those are mostly in the bigger banks. The smaller banks hold less securities. It's the commercial real estate assets that are certainly underwater on the mark, which if you run a bank and you're upside down, you may not have a cash crunch, so to speak. You may not have a bank run, and you may not be insolvent as a result of that. But that's certainly not going to be a environment that's conducive to growing your balance sheet very aggressively and extending credit the way that we were used to in the years prior. I think going into the SVB crisis, commercial real estate lending from the banking sector was growing about 13% year over year. It's down to about 0 now. So there's been a very significant slowdown in overall bank lending. And that's kind of what I'm watching for the banking sector. And as long as the yield curve remains inverted and it's sort of unprofitable to make, loans across, economic assets, I think that environment probably remains.
I think
so.
it's
One thing I just wanted to add to Eric's point, because he brought up a very valid component, which is that commercial loans and leases have really not grown, certainly in inflation-adjusted terms. The one area of growth that's actually, really robust and quite remarkable is the lending to non-depository financial institutions, is what it's referred to. In other words, private credit. That's been growing like crazy. And if you pull that out, I think last growth was, something like 15% year over year. If you pull that out, the absolute number in terms of loans and leases is actually negative.
And the question is why that is. And I think, Eric, you hit upon it. The real issue here is, why don't banks want to lend?
Right.
You get constant macro assurances that the U.S. economy is just fine. The rest of the overseas economy, China's doing stimulus that should boost conditions worldwide. Europe is supposedly coming out of its recession. We see the same thing in Europe, by the way, too. Lending exclusively to non-banks or investment funds.
Right. Well, Jeff, one of the things that you look at is obviously the Eurodollar market and the Eurodollar curve. I look more just at the spot Treasury curve, and we have heard that the inverted yield curve didn't work this time because the curve inverted, and we haven't had.
This time is always different.
This time is different. We haven't had the supposed recession, and sure, this time is different from the standpoint of from the time the yield curve inverted to now certainly exceeds past instances where recessions would have occurred at this point. However, we have to remember that all of these indicators aren't mythology. They're not voodoo. They lead economic conditions because of a mechanical link of how they impact the economy. So the yield curve inverted at the end of 2022. And why is the yield curve a powerful leading indicator? It's because it generally foreshadows future bank lending conditions. At the end of 2022, real bank lending was growing basically double digits. It was somewhere in between 8 to 10%. And as we just quoted, real bank lending is now negative. So the yield curve did properly predict a very significant slowdown in bank lending. We haven't had the recessionary event that normally follows a yield curve inversion. I think there's a whole host of reasons why that hasn't happened yet. But I think that it's important to recognize that these leading indicators are not, magic, in the sense that once they invert or once the leading indicators go negative, certain things happen. It's really a mechanical link. And if you go through the traditional leading indicators, you can really start to pick apart what is that specific indicator supposed to lead later in the economy, and has that happened yet? And in certain instances, we have not seen that lead, lag, follow through. In other instances, we have. So I think that's an important point to mention as well.
Yeah, it came coming back to, why aren't banks doing what they should be doing? I mean, they should be expanding their balance sheets in this type of environment. And it comes back to some form of risk aversion. Not only are they, only lending to private equity and similar, non-bank investment opportunities, they're also buying a crap ton of government bonds. This is common, not just the United States, but also European banks are doing the same thing. So we're seeing from the banking system a bunch of signals that are defensive in nature. They're saying we don't want to expand our balance sheet. And as you pointed out, as Mike pointed out, negative real lending to the real economy, which is a big deal to begin with. So the risk aversion behavior that's still ongoing. In fact, you could argue some of the statistics suggest that it's actually accelerating in that direction. So what is it that they're out there looking for? And I don't, back to what we started with the original question, I don't necessarily believe it's a cash crunch. But as Mike also said, if you get a collision of these types of different angles coming together at the same time, where banks who are already risk averse, they're already very defensive to begin with, and then something unexpected comes along, it's not like we're expecting, massive deposit flights from a bunch of SVB type of institutions, but you could get a situation where you have a more than hiccup in the wholesale marketplace that causes a little bit more than just an annoying disruption for Jay Powell. So I don't want to say that there's a systemic potential problem here, that it's going to lead to something like 2008 or worse. But there is a number of different signals that if they line up in just the right way, there's a non-trivial chance that something bigger happens than just, oh, this is no big deal, or this is some kind of triviality. Right. So
I think one of the most important things also, Jeff, when we talk about the banking system and their loan books, is we're always looking for credit stress, right? Because credit stress would ultimately cause the harsher contraction in credit that's more associated with disinflationary or deflationary events in the economy. It's very difficult to get widespread credit stress in the economy without job losses or a significant increase in the unemployment rate. So if that starts to manifest and we do get heavier job losses, particularly in the cyclical sectors, where they generally appear first, then we could start to see more delinquencies on some of the consumer-facing loans, and that could, potentially impact some of the more, metrics that we were talking about in the bank balance sheet. But that still hasn't fully manifested yet. We always see job losses appear in large size in cyclical sectors, predominantly construction and manufacturing. We're starting to see the early signs of job losses in manufacturing. We've had several months in a row of job losses in manufacturing, still not yet in construction. But I think it's important for everyone to remember that the way that stress builds in the economy and the way that services and the things that people generally refer to in the economy, the only way that those things pull or contract or experience a pullback is if you get job losses in cyclical early sectors. Those people who become unemployed, they're the ones that create the downstream stress, either on the bank balance sheet or on the more lagging service-oriented spending baskets. We haven't quite seen that develop yet, although the signs are building that it's obviously starting with manufacturing job losses first this time around.
Well, I think that's the thing that's the bank that's holding up the banking system. Why are they defensive? Is because they are thinking ahead to exactly what you're saying. We've already seen credit deteriorate quite substantially already. I mean, Ally Financial, who was the other one? There's a couple other banks that reported recently that their loan books are starting to look really ugly, and some of their credit card numbers. Citigroup was another one. JP Morgan, rising loan loss reserves and loan credit deterioration in their books already, when the economy hasn't experienced the widespread layoffs. So if we're in that shape where we're seeing credit quality to go down this much before we even get to the worst part of any potential contraction, I think that's the reason why banks are being so defensive. It's not because they're thinking everything's just fine. They're preparing for that potential as more than just a small potential.
Mm-hmm. And also, once they price in the risk premium that's required to profitably make a loan against what they would make just buying short-term government paper, you start to price
the role of the gig economy in this process, because typically those who are 18 to 21, and certainly a growing proportion of those 21 to 25, are not eligible to do things like drive Uber. And if you isolate the unemployment in those groups, it's exploded relative to the other. So I just think part of what we're actually seeing is that there is a flexibility in the economy that has allowed people to find substitutes.
We broke up with you a little bit, Mike, but I understand the gist of what he was saying, and I'll piggyback on that. And I think what he's saying is accurate in the sense that there's a lot of
there's really margin for error, right? There's a bigger margin for error.
Well, there's a lot of changes in the economy that are happening in terms of businesses preferencing part-time labor over full-time labor, which is all early indications that you see. However, the one pushback, and I think Mike might have just dropped off, the one pushback that I have is that even if we are seeing this replacement effect of people getting laid off from certain types of jobs and then driving Uber or gig economy, we're still not seeing those job losses accumulate in the cyclical sectors of construction and manufacturing. It has started recently in manufacturing, but you can get, we've seen, steady strings of tech layoffs for really the better part of 2 years, but it's the self-reinforcing nature of job losses that's what creates an economic downturn or recession. And it really does need to come from that goods economy, is what we call it, construction and manufacturing. That's when it really begins to feed on itself. We haven't seen that really develop strongly yet, although I do believe that that is still on the way as long as this lag has been.
Yeah, it has been unusually long, but that doesn't mean it's still not a cycle. I think that's one of the hardest to get everybody to realize, is that just because it's taking forever doesn't mean it's not happening. And again, you look at all of the financial indications, whether it be curves or whatnot, or even just what we're talking about here with banks refusing to expand their balance sheets, which they would do if they felt that, as you pointed out, Eric, that the risk premium to doing lending or any kind of real economy business was small enough, they would absolutely do it. So something is forcing them to reevaluate the opportunities. And we keep coming back to this, whether it's slow shift or not, it still looks the same way. If it walks like a duck and it quacks like a duck, it's probably a duck.
Banks always have a willingness to lend at a price, right? Other than really extreme, other than really extreme situations, they'll always be willing to lend at a price. But with the front end at 5 and the middle part of the curve, closer to 4, they have to price in a healthy spread to make returns above what they could make just buying the short-term paper. And once they tack on that spread, especially for the consumer-facing stuff, you're up there at 9, 10, 11%, which is kind of where the banks would be willing to make a loan. And then when you get to the other side, no one's willing to take money at that price.
Well, that's the other part of it too, is that there isn't a whole lot of demand for borrowing either, which is another concerning sign as well. It's like it's malaise from both angles. Let's switch gears a little bit here. Let's get to another question. The next question is about, there's a couple of them here. A question about interest rates, because we got, interest rates were going lower since the end of April in the United States with Treasury yields. We'll get Mike back in just a second. Got a message from Mike. So we got interest rates that were moving lower through the middle part of the year. Global bond rally. We got, lower interest rates in Europe since May. The Fed was higher for longer, then the ECB cut, and then the Fed started to cut. So the Fed finally cuts, it gets out of the way, and interest rates go higher, which has led to, right now, social media is abuzz with Fed cuts rates and rates go higher. So let's talk about why rates might be going higher. I've already addressed this topic several times, but let's get everybody else's opinion. Why are rates going higher since the Fed cut?
Mike, if your connection works, I'll give you the first shot at that one.
I think there's two separate components to it. One is that we had an incredible rates rally leading into the Fed cutting, right? So there's some give back associated with that. It's fairly natural. The second component, my partner Harley has highlighted this significantly, is that because of the election, there's actually been a significant increase in the implied volatility of the moves around rates. That in turn, people to hold them. Right, you need to either hedge those positions or you need to step to the side. I would argue that a lot of what we're seeing right now is just a step to the side ahead of the election.
I always try and explain these moves as best as possible, just with pure macroeconomic factors. And I think there's probably a laundry list of reasons why rates move, and there probably always is a laundry list of reasons why rates move. But I think that the simplest answer is in July. In August, we received the July jobs report. And we had an unemployment rate that surprised consensus to the upside. And it very much looked like at that moment that the unemployment rate was not only rising, but the pace of the increase was beginning to accelerate in a fashion that normally that normally is at the onset of recessionary conditions. So the U.S. as well as the rest of the world had this freak out moment that was very much, in my opinion, tied to having a realization that the recession, the long-awaited recession, is right here, right now. That caused a big rally in interest rates, and it also caused, for the first time, a very significant decline in stocks. It was associated with this yen carry trade that was sort of the explanation as to why it happened. But I always find that, these are explanations that come in after the fact, right? That explain why things happen.
Narratives.
Yeah, exactly. And we're in this situation where stocks, if you think about a really binary model of the stock market, particularly the S&P 500 or Mag 7, because of a lot of the passive phenomenons that Mike has outlined better than anyone, markets tend to kind of just melt up until there's a recession, and then they fall very quickly and very hard. So when we had that recession scare with the unemployment rate rising more than consensus and taking on what looked like the beginning of that nonlinear path, we had bond yields rally, stocks go down, textbook recessionary trade. In the subsequent two jobs reports, the market was very braced for the unemployment rate to go up again from 4.3 to 4.4. And what happened is, we had the rate go from 4.3 to 4.2 to 4.1, and it completely erased those fears that the recession is here at this present moment. And it sort of had the phenomenon of delaying the recession once more, which caused everyone to melt up stocks again because the recession didn't come, and as well as reverse a lot of the move that we had in bonds. Just happened to coincide with the Fed cutting 50 basis points. But in my opinion, the reversal of that unemployment rate trajectory was what most explains the move in bond yields. Should the next jobs report show the unemployment rate go ticking back up, I would anticipate bond yields to go down again. However, on the flip side, if we print a 4.0 on the next unemployment, then there's going to be pressure on the Fed to stop cutting.
Well, that gets us into a next question. Before we get there, though, I think, there's a couple of things. First of all, I agree with what Mike said, and Eric too, for different reasons. As far as bond yields go up, people may not realize this. Bond yields always go up after the first rate cut. Always. Every single time. You go back to 2007, the Fed cut by 50 basis points in September 2007. Bond yields are going higher into October. And by the way, the Fed actually looked at the same things at the same time too. They cut by 50 basis points. They did another 25 basis point cut in October of 2007. And they expected to be done at that point. In fact, a lot of people expected the same thing because very similarly, there was a summertime recession scare that got everybody, bond yields went down. Everybody got really excited. And of course, there was also the eruption of the monetary crisis as well. The Fed cuts by 50 basis points. And right around the time the Fed cut by 50, things started to look better. The payroll report picked up. It actually picked up again the month after, and everybody said recession has been called off. So part of the answer to the question why interest rates rising is because this is the way it always goes. It's an uncertain world, and nothing ever goes in a straight line, including recessions. There are so many different false starts in this dynamic that it's very difficult to say, okay, this is the exact timing. But yet that's what that's where the narratives really come in. And then the other thing, agreeing with Mike that, the cost of holding treasury instruments is going up. And given the pattern that we're talking about, it's more difficult for buyers to buy, and they don't want to buy anyway. But to go back to something else, the yen carry trade, that was also related to the macro situation, because so much of what the Japanese financials are exposed to is itself exposed to the U.S. financial and economic situation. So the yen carry trade was really another factor of recognizing the macro risks that were developing at the time. And everything that we've seen from the yen carry traders themselves, including several explicit statements, they still want to get out. They're still looking to exit. It's one of the reasons we talked about before with the banking system, why there's so much risk aversion. The yen carry traders are with the banks. They're saying, we think that the macro risk here is still tremendously high, and we would like to exit our positions because we still believe that the U.S. economy is in much worse shape than most people realize. We would just like to do it under a more orderly circumstances than what erupted in early August. So when we look at interest rates rising, it's not really that interest rates are rising. They're just behaving like a dynamic marketplace where nothing ever goes in a straight line. Mm-hmm. But that leads us, unless somebody else has anything else to say, that leads us into the next question. The next question is, this is the topic we've gotten all over social media the last couple of days. Does the Fed regret its rate cut? Does it regret either even just cutting it all? Does it regret doing 50 basis points? Because as Eric and I were talking about before we started here, the recession has been called off. The payrolls look fantastic. The market, the Fed overreacted to a couple of weak data points. And so now they're trying to walk back the rate cut because it was inappropriate. Mm-hmm.
Well, wait, but before we move on, Jeff, I just sent you a picture actually of the unemployment rate for 16 to 24. And I wanted to actually just highlight that because this is actually a fairly big deal. When we talk about the unemployment numbers and we talk about the dynamics of claims, et cetera, it's really important for people to realize that something has very substantially changed versus any prior cycle we've had before, which is the gig economy. Right? The gig economy, effectively, if I lose my job, I have a choice. I can file for unemployment, or I can start taking the car that I was using to drive to work or to drive from my home to go to the groceries. And I can use that to drive. And because I've already paying for my car, right? It's a sunk cost because I've already got my insurance, et cetera. It's basically a pure cash transfer that makes somewhere around $52,000 a year is the average income for an Uber driver. They're depleting their asset, they're lowering it, et cetera. The one group for whom this is really is that 16 to 24 group. For various reasons, they're prohibited from driving for Uber in many states. Just not.
I think we lost Mike again.
I think we might have lost him again.
Yeah. So I understand. I think there's a lot of different reasons why unemployment has looked the way it has. To begin with, I think the most important aspect of the unemployment rate and unemployment as a phenomenon is the lack of hiring, which is, to me, far more important than layoffs. Layoffs tend to come at the end. What really triggers a recession, or at least the start of the recession process, is that companies say, we don't want to hire anybody, and the workers that we do have, we're going to start cutting their hours. We're going to take all of these defensive measures that lead to, lower incomes across the board. And if we're seeing, a bunch of people that are getting into, they're being forced into a gig job just to make ends meet along the way, even though that doesn't show up as unemployment, that certainly has a major impact in psychology as well as real spending in the real economy.
Mm-hmm. Yeah, I mean, if you're taking a lesser paying job, aggregate income in the economy is gonna go down.
Or even, it's the old Milton Friedman permanent income hypothesis, right? Where you act differently. Where I'm on a temporary job, but at least there's money coming in. But it's not my full-time job, but it's not the job I want. So I'm going to be more cautious in what I do.
Absolutely, yeah, absolutely. And all of these things that you just mentioned, you outlined 4 or 5 things, including cutting hours worked and shifting to part-time labor, all things that companies do before layoffs, right? Layoffs come last because layoffs are actually expensive for a company to do. You don't want to have to rehire labor. It's very costly. If you don't hire a person, you have to retrain them. They're basically, so effectively, it's like a net loss to you as a company for the first several months while you train them up to get them to actually be productive at what it is that you want them to do. So they really, and there's evidence more so in recent decades as opposed to in past decades, they're retaining this labor longer and longer and longer because it's been very difficult, especially again in this goods economy where it's a more technical type of job, especially like a manufacturing floor, it's very difficult to find the labor that's willing to do the job. So they're very, very reluctant to get rid of this full-time labor. So we've seen them start doing a lot of these, what we would call leading employment actions for basically 12 to 18 months already. It hasn't shown up in non-farm payrolls yet in the form of actual layoffs, but we're seeing companies do all of these things. And the reason that they do that is ultimately to protect profit margins as the economy starts to slow and their margins get squeezed.
Let me ask you one thing too about this, Eric. Return to office policies. Many people have said, and I think you might agree with it, that return to office policies are layoffs in disguise because companies don't want to be the bad guy laying off workers. So they're imposing stricter and stricter return to office policies, basically inviting their workers to leave on their own volition rather than forcing them out. It is another, like you said, leading indicator where businesses are taking a proactive step to reduce their cost structure, but doing it in a way that is not familiar to the traditional recession cycle.
I think there's absolutely something to that for sure. I think that it's not a surprise that we're seeing companies call people back to office. Certainly employees prefer a hybrid type of a schedule where they're able to work from home.
I work from home and I'll never go back.
There's no surprise there. And it also is kind of like a net reduction in income by going back to the office because of, you have to pay for your own commuting costs and all these things, generally
or
speaking.
Just time. I mean, for a lot of people, it's lost time. Yeah.
And a lot of people for food and dry cleaning and all this type of stuff. It's not, the most material thing in the world, but it is, incrementally something that makes workers dissatisfied. I do want to continue to emphasize this one point though, and I feel like I'm beating a dead horse or a dog with a bone here, but the goods economy of construction and manufacturing has never worked from home, right? You can't work from home if you're in the goods economy. There's never been, and I don't think there ever will be, a recession without the lion's share of the job losses coming from that goods economy of construction and manufacturing. So we really need to see the job losses accumulate there. Again, we're starting to see that appear in the manufacturing sector. I do believe that those job losses will continue, not yet appearing in construction. But anytime I talk about the labor market, I always want to emphasize that while I do believe that all of these things are factors that are playing in, like what Mike was saying about the gig economy and taking lesser paying jobs, I just always want to emphasize that remains the most important thing. And I don't want any statements I make to overshadow that being the driving force here.
Mike is back.
Yeah, those tunnels will kill you on Amtrak.
Well, we appreciate the fact that you're joining us while you're traveling on the train. I mean, that's fantastic. Let's go on. Let's get to that question. Does the Fed regret its rate cuts? I think this will be an easy answer, and there's probably a lot that we'll agree on here. Mike, while we have you, why don't you go?
Exactly. Well, all right. I'm going to turn off my camera to conserve bandwidth, but I can't imagine that they do. Right. To Jeff's point, it is not uncommon for rates to rise, for the long end to rise in reaction to the first rate cut. I put out a tweet earlier today pointing out that, like, depending on what time period you use, you're going to get very different answers. But somewhere around 50% of all changes in interest rate of the Fed policy rate have an unanticipated change in the opposite direction out the curve. So we really can't actually assign anything to it. I would suggest that the Fed knows that their rate is restrictive. We see the impact of that in the rate sensitive components of the economy. Housing is in the doldrums. Auto sales are in the doldrums. Appliance sales, I keep getting offers for, people trying to sell me appliances at 50% discounts. The simple reality is I don't think that they regret it. And ultimately, I think we'll probably still find out that they were behind the curve and they're cutting.
Eric, you want to take that too?
Yeah, I agree. I don't think they regret it. I think that they very much do believe that their current policy is well above the quote unquote neutral rate, which in their mind means that they're still restrictive. I agree with Mike that the evidence that they're still restrictive is still present in the economy, particularly the slowdown in the cyclical sectors. Housing units under construction are coming down. Building permits remain soft. Housing volumes remain soft. Again, curve remains inverted. All of those are signs that the Fed is still in a restrictive policy stance, incrementally less restrictive than they were when it was 5.5, but still restrictive. And I don't think that they regret the move. I think that they're still very much on a path to what they think is neutral, which is about 3.5. That will be revised if things don't develop the way they see it, or some phrase that Powell uses that's similar to that. But I still think that for the time being, they're on a path to cutting to 3.5. I think it'd take a material shift in the data to change that. If the unemployment rate in the next report drops to 4, or if we see a 3 handle again on unemployment, which I don't expect, but if we do see that, then they would actually, I think, stop their rate hiking campaign. But I think that they do believe, and based on their SEP, they're in the mindset that the unemployment rate is trending higher. They penciled in 4.4 for 2025. So I think that, it's definitely too early for them to have regret about that decision.
Well, they've penciled in 4.2 to start with, so they already had to raise that, which is really the reason why they cut rates to begin with. When their SEP says unemployment rate's going to stop here, and then it goes above that level, they're already thinking we need
and
to
cut
change.
They always change. Exactly.
Yeah, exactly. And I think, this whole thing about the Fed regretting its rate cuts, it's basically a narrative searching to explain two things. One is the backup in interest rates. So everybody's got the backup in interest rates is supposed to be some paradigm shift in the marketplace when I think we all agree that's not. And it's also constructed by Jay Powell from the very press conference following the rate cut announcement said, we didn't really want to cut by 50. We just kind of did. He was walking back the urgency and the panic that was associated with doing a 50 basis point rate cut because the Fed had turned around so quickly from where it was the meeting before then. They went from we don't need to cut rates in July to holy crap, 50 basis points. And so Jay Powell came out to try to calm everyone down and say, this is really not a big deal. Mm-hmm. And so I think a lot of people are putting those two things together when they don't really go together. So market rates are going up. Jay Powell sounds less aggressive, and he's not the only one. I mean, Christopher Waller came out and absolutely lied his ass off when he said after the rate cut that, we did it because consumer price rates are going down. When in early September, just a couple weeks before they cut rates, he said, I'm really afraid of the unemployment situation here. We need to act. And now he's changing his tune. No. So I think people are making way too much of what the Federal Reserve is trying to do in walking back that 50 basis point rate cut, because the Fed does not want people to start to believe that they're panicking. And at the same time, because rates are going up, it sounds like there's this major shift in the economy or in the marketplace or something. And so the idea that the Fed is regretting its rate cut is just really trying to put two things together that don't necessarily go together. If anything,
we always backfill the narrative after the fact, right?
Well, we kind of have to. I mean, we don't have actual insight into what's really happening. Exactly. I mean, at least this one is internally consistent. At least you can look at these things and say, okay, these are actually happening, whereas most of the narratives are just grabbing things out of the sky.
Right. I mean, I think there's something to be said for the fact that the Fed's I don't want to call it the Fed's official forward guidance, but in between meetings, we have the list of board members that not the minutes, the unofficial speak from all of the FOMC members that do their private speeches, their media appearances, and all of that commentary is, I think, a disservice to the institution. I think it's not great. I don't think that that's the way that it used to be done. That's what I think causes the market to make it seem like the Fed is, flip-flopping or going back and forth. If you only look at Jay Powell's comments, it's definitely a little bit more consistent across time. He obviously changes his mind. He's obviously made some mistakes. But if you take every single headline that says, Fed member Goolsbee or Fed member, and you take every one of those statements it gets really ridiculous, and I think that
it's just pure noise. It's just
all noise. There's not a lot of signal there, and at the end of the day, there's really only one guy that matters, and he doesn't speak without it being highly, highly calculated. Everyone else kind of flies off the handle, a little bit more unscripted.
I would just add, as somebody who has watched the Fed for a very long time and being friends with people who have watched it even longer, this is unprecedented. The politicization, the positioning, the need for attention, et cetera, that is occurring from various Fed governors. Access to these guys used to be very carefully husbanded, right? It was like, you felt like you were getting an audience with the Pope if you were hearing a Fed speaker. At this point, it's literally like days that end in Y have Fed speakers on regular occasions.
Well, I think it's because it's become sort of a celebrity thing. It's not. There's really no legitimate function that's served by all of this media attention. I suppose you could argue that some of that kind of gets out there, the messages that the subtext that certain Fed officials want to send at certain times, but it really is just more about generating headlines for the sake of generating headlines. And if there is any legitimate purpose to it, it's not really hard to see it at most of these times, especially considering the conditions that we have now, where we're in a period of a high degree of uncertainty. I know I always say it's always uncertain. The future is always uncertain, but the level of uncertainty at cyclical inflections or potential cyclical inflections is always heightened to begin with. And most people get their information about these inflections and as well as the economy from people like Fed speakers. So it actually doesn't help in that respect either, because it simply just makes it even more muddy and cloudy. Anybody else have anything to say about the Fed regretting rate cuts before we move on to the next one? All right, let's move on to the next one. Gold. This is a very common theme for very obvious reasons. We've got record gold prices. People want to know what's going on with the gold market. Is this another inflation signal? Is this something else entirely? Because you see, for example, the copper to gold ratio continues to hit new lows, which is not a good sign there. So what's everybody's opinion on record high gold prices? Mike, you want to start?
Yeah, well, since I have one of my brief moments of connection, sure, let's go for it. The point that I'd make on gold is twofold. One is that, as you point out, the industrial metals and the industrial use commodities relative to gold prices continue to decline, which generally indicates weakness in the overall economic sector. We actually saw the IMF lower their forecast for global growth for next year fairly significantly in just the past couple of days, with an emphasis on emerging markets. I would argue that what is going on right now is largely a function of China, Russia, and others choosing to buy gold as an alternative, both on an alternative to treasuries, both on an official capacity as well as within those countries. People are seeking mechanisms for safety. Unfortunately, that's now manifesting itself in a narrative in the United States that, we're going to see the end of the dollar, that it's going to be a collapse, that there's going to be, gold to the moon, all that sort of stuff. And so far, what I would argue we haven't really seen is highly levered positioning in gold in the traditional sense that could create a 2008 type gold sell-off in response to the lack of funding availability. But what we are absolutely seeing is we're seeing people try to optionalize this. And so if I look at things like gold skew, which would reflect the fact that people are buying out of the money calls on gold as compared to buying gold itself, those very much are bid right now. And so we are seeing people effectively try to speculate on a higher gold price. But that, to me, is the primary component of the signal that we're getting right now, that people are speculating, which is not really a surprise, and it's not going to be changed by interest rates going from 5% to 6% or even 7%.
Eric?
Well, I see a lot of the comments on the YouTube channel here that are very optimistic about gold, so I'm not going to say anything negative at risk of being attacked by the mob. No, I'm only kidding. I'm certainly not a gold expert. I think that at the end of the day, gold is a monetary asset. I do believe that it is the ultimate store of value. And I think that over long periods of time, gold reflects, changes in monetary conditions. But I think that there's a misconception that, gold reprices like in a perfectly linear way. So whenever there's changes in inflation, that gold immediately reflects that price. If you look at the history of gold, it tends to be kind of gappy and then consolidates and then gappy and then it consolidates. I'm not really a technician either, so I probably shouldn't have used those terms. But I think that we're experiencing a huge run up in gold, and I'm not sure it's unrelated to or not a lagged effect of huge monetary inflation that we experienced in 2021 and 22. It just took a while to catch up. And then there's always the, euphoria and stuff that comes along with any big bull run in an asset. But I think over long periods of time, there's, good isms with gold, like, 1 ounce of gold generally buys one tailored men's suit, or a whole bunch of these things like that. And, if you look at it over really long periods of time, I think that a lot of those will generally hold up to be roughly correct. But at any given moment, there's these big bull runs and there's big bear periods with pessimism and optimism spread around. But, I'm not one that can properly analyze all the things moving the gold market. But I think that over time, it's the ultimate store of value asset. And that's kind of my 2 cents on gold.
Yeah, I look at gold as a hedge, but not against inflation. It's actually a terrible inflation hedge. In fact, regular levels of inflation, gold is going to underperform. Gold only really shines, and I use that pun intended, when big things are on the horizon. You look at the current gold market bull run, it goes back to late 2018 and early 2019. I'm not saying the gold market and gold people picked out the pandemic before it happened. What the gold market was saying is that as we ended the 2010s, we ended the 2010s on a very sour note, even before we got to the pandemic and everything else that happened in the 2020s. There is some short run and intermediate term correlation with interest rates, which are always a part of this. They're always a factor. So you can look at rising gold prices as a derivative of potential future interest rates, though that's a much looser signal and correlation than it's often made out to be too. But, looking at gold as an ultimate hedge, what it's suggesting is that it's still moving in the same direction that it was going into or heading into at the end of the 2010s and into the 2020s, which when you say it that way sounds a lot like what financial markets have been doing. I don't mean stocks, but bond curves and everything else, swaps, for example, what they have been pricing at the same time in the same way. It's a consistent corroborative signal where the gold market is saying we don't like where things are going. Now, we don't know exactly what that means, but the gold market is saying we don't like where things are going. The swap market is saying we don't like where things are going. Even the treasury cash market is saying we don't like where things are going. And so it's up to us to kind of fill in those blanks. But you notice how everything that we've talked about in this Q&A kind of comes back to the same thing. Why is gold rising? Why are interest rates falling? Why aren't banks lending? I mean, there's only a short list of scenarios that would fit all of these different characteristics. We keep coming back to that same thing, and it seems like it's the most obvious explanation, which is why I think a lot of people just reject it because it seems too obvious almost in that sense. So, the copper to gold ratio, which is, deeply fundamental, and I don't think people realize how much that corresponds with other fundamental signals around the economy, not just interest rate swaps, but you can line up the Chinese 10-year treasury bond yield with copper to gold, and they're almost perfectly matching, which is a signal about economic fundamentals through China and the rest of the world that is correlating and corresponding to a whole bunch of other signals. So like I said, we keep coming back to the same things from different angles. It really leaves us with a powerful case for the opposite of inflation. Anything else?
So I'm much closer to Jeff on gold. I respect the 5,000-year history. I understand why people think it's for value.
This is what happens when you use a government Wi-Fi network.
Yeah. Well, if Mike doesn't get attacked by the mob for his internet connection, he'll get attacked for his views on gold.
Yeah. Can you guys hear me now?
Yeah, now we can. Yeah, now we can.
Can you hear? Okay. All right. All I was saying is gold is actually a hedge against effectively a collapse of a sovereign entity, right? So when a government loses its taxing authority, in the attempt to continue to maintain control, they will of course continue to spend even as they can no longer tax. And that's really what gold is protecting against. That, you know, you're basically saying humanity will survive and people will still value trade. And this is a dense component that I can trade with low risk of it being fake, although it's significantly higher now that we have the technology to do things like melt down tungsten, which has similar atomic weight. But you know, the idea that this is somehow or another a sign that, you know, this is the apocalypse upon us, to me is much more a statement of the fact that nobody in society actually wants to say, here are some of the hard choices that we have to make, and a general belief that nobody can do it.
It's a paradigm hedge. It's not an end of the world hedge. It's okay, things worked a certain way, and we can see that they're probably not viable too much longer. You know, too much longer is a loose term too. So therefore, we want something that bridges the divide between where we are today and where we're going to be tomorrow, because where we're going to be tomorrow increasingly looks different than where we are today. And I think that's really why we look at gold. And people kind of throw their narratives on top of that too. Does that mean it's the end of the dollar system? Well, no, not necessarily. It just means something.
Let me push a question back to Jeff and Mike as well. And again, I'm not, you know, a big gold bug. I really don't focus on the gold market all that much. But in the way that you guys are looking at gold, what in your mind would explain the move from, let's say, $300, $400, $500 an ounce in the 1990s to $2,700 an ounce now? Would you say that, you know, we're 4 times more likely to have the end of a sovereign? You know, what could explain the sort of upward trajectory over a long period of time? Is it like we're increasingly moving towards an end of sovereign environment, or is there some aspect where gold does have to maintain its purchasing power in local currency terms as well?
Well, to your point about purchasing power, right? You know, there's the old adage, as you pointed out, about, you know, finally, a men's suit, a tailored men's suit. I can tell you with 100% certainty, I can go buy a finely tailored men's suit in various places around the world, including New York City, for somewhere in the neighborhood of $1,100 to $1,200. So overvalued. If I compare gold against American housing, it's significantly overvalued. If I compare it against labor around the world, it is significantly overvalued. So what I would argue actually happened in the 99 time period is that we came to an end in which gold was significantly undervalued and had been depressed by central bank selling and the basic idea that nobody was ever going to need it again. And there was an element of remonetization of it. I mean, I could tell you, I remember having conversations with John Tomaso, who used to be the UBS top-ranked metals analyst in 2001, and I was buying gold and talking to him, and he's like, gold will never top $350 an ounce because the supply of jewelry that will be recycled, it's just going to pile in if it ever exceeds that level. There's thousands and thousands of sellers. I think a much more valid comparison would be, you know, what Jeff was referring to when you look at things like copper gold. I'm more sanguine about the retreat in copper gold because I just think it's part of a trend that's been in place since the 1800s. Industrial metals are becoming more and more common. They're easier to obtain. They're easier to recycle. The utility of a copper wire has shifted from a very thick 4-gauge wire to a ton of strands of infinitesimally small wires that makes it much easier to use lower quantities of copper to obtain the same outcomes. We'll see the exact same thing in EVs, and this process will continue ad infinitum. Gold is somewhat unique in that its utility is measured in its mass. I get a gram of gold or an ounce of gold, and I realize that's a weight as compared to a unit of mass. But I get a gram of gold, and it's going to have its value by being gold. If I get a gram of copper, it has no value to me until it's been drawn into wire, right? And if that wire is thinner and does the exact same thing and therefore needs less copper, perfect. I'm perfectly happy to use less copper. I don't care. I'm using it for transmission. Gold, I can't do that. And as a result, technology supports the price of gold relative to industrial metals and oil and anything else that we use.
Yeah, we've seen the price of copper go up pretty substantially since the middle 2000s too. So there's a bit of inflation in that. What I would say is that, taking a step back and look at this in big picture terms, where did gold surge? It surged in the 1970s when there was a paradigm shift in the way the world actually worked at that time. And then it kind of went quiet and dark through the 1980s and 1990s into the early 2000s. And then I don't think it's coincidence that gold started to reignite at the tail end of the Eurodollar era. Essentially, gold investors started to piece together that the system was reaching its inevitable conclusion. And of course, that was the 2008 crisis, which is why gold was heading higher into it, and gold headed higher after it. And while there was a pause in gold prices in the middle 2010s, it started to come back in the later 2010s because many people started to realize that all the problems that we had in the early 2010s were never actually solved, and we're still going through that transformation and transition. So gold was essentially dormant when the world worked the way we wanted the world to work. We had global prosperity, things seemed to be relatively prosperous. It began to sense that things were going off the rails in the early 2000s and started to get bid. And over time, people realized that nothing has really changed in that respect. And we haven't completed the paradigm shift. And so there is still that need to bridge the divide between where we were and where we're likely to go, even though nobody has any idea where we're likely to go. So I think the big picture explains gold, and then you can throw a bunch of other factors on top of it, like low interest rates and everything else. Oh,